The other variance analysis that we look at in Chapter 16 is breaking down the sales volume variance. So we break it down into a sales quantity variance and a sales mix variance. And we look at those variances in terms of contribution margin. So in Chapter 14, we have the sales volume variance and our flexible budget. So our sales price variance is the actual sales times the difference between the budgeted and the actual selling price per unit. And the total sales volume variance is the budgeted sales price times the difference between budgeted and actual sales volumes. So then we can look at that even further when we break it down into the sales quantity variance and the sales mix variance. We're then going to further divide the sales quantity variance into the market size variance and the market share variance. So we'll start with the sales quantity variance. This looks at the total units of all products sold and the budgeted total units of all products sold. It's the effect on contribution and income of deviations in the number of units sold from the total number of budgeted units to be sold. So this calculation is as follows. Take the total units of all products to be sold minus the budgeted total units times the budgeted sales mix times the budget contribution margin per unit of the product or sales mix. So when we're looking at the actual sales mix variance, so the sales mix relationship, when we've looked at that in other chapters. So our sales mix variance is attributed to changes in our actual sales mix. So our budgeted mix versus our actual mix and what that does to the contribution margin. So we're going to go back to this example from chapter 14 with our Schmidt Machinery Company, where we have two products and we have a 3-to-1 sales mix on those products. So what we're looking at for the budget is what happens to our actual budget when we don't maintain that 3-to-1 relationship with sales mix in our sales. So we have then now the actual results for that income statement. So we've sold a different proportion of units. We had a different sales price. So we look at our sales price and contribution margin per item, but we sold a different number of units. So when we're looking at the actual and budgeted sales mix for the year. So first, we have that 3-to-1 sales mix. Okay, that's our budgeted sales mix. It's a 75% ratio to a 25% ratio or a 3-to-1 ratio. However, our actual results show a 68% to 32% ratio. So when we're looking at it, the sales mix variance to the sales quantity variance. So now we look at the total units we sold versus the sales mix and our contribution margin. So first we have our product of the XB1. Our budgeted sales mix of that product was 25% of sales. We actually sold 32% of total sales. The contribution margin is $350. Because we sold more of this product than we budgeted, we have favorable sales mix and sales quantity variances. However, that is offset by the fact that we budgeted to sell 75% of our second product and we actually only sold 68%. So we have an unfavorable sales mix variance for that product. So when we net out our sales mix variance, sales quantity variance for our total sales volume variance, even though we had an unfavorable sales mix variance with our product FB33, all told we had a favorable sales volume variance. So when we look at this analysis, we have different things. So the change in sales mix had a positive effect, mainly because the product has a higher budgeted contribution margin per unit. So our favorable results were good for us. Now we're going to look at the market variances. We're going to break that further down. So the market size variance looks at the change of our market size of a firm's product on the operating results in the firm, including total budgeted margin. So then we're looking at our actual market size in units minus the budgeted market size in units times our budgeted market share times the weighted average budgeted contribution margin per unit. So we're bringing a lot of different chapters together. If you remember when we did the weighted average budgeted contribution margin per unit for CVP analysis. And the market share variance, which is the effect of changes in our proportion of the total market and how that can affect our operating results. So in this example, we assumed a budgeted market size of 40,000 units and a budgeted market share of 10%. What we actually result in, so we see we have a market size variance. So our market size was our actual in units of 31,250 units to the budgeted of 40,000 times our 10% budgeted market share times the weighted average contribution margin per unit. So we have an unfavorable market size variance. We do have a favorable market share variance. However, our budgeted market share was 10% and our actual market share ended up being 16%. So when we look at these results, even though we had a market size variance, we end up with a favorable market share variance. So our market size was 8,750 units smaller than expected, but our market share was 6% higher than our budgeted proportion. The increase in that market share offset that result. So those are the different variance analysis that we can complete looking at our sales volume variance and how we break that down further. When we look at the 5 steps of strategic decision making from chapter 1 and we apply that to our Schmidt refinery, we want to know what were the strategic effects of this analysis. Well, first, we're a differentiated firm based on quality, design, and functionality. What was the alternative action? So one of the things that we're looking at is whether or not we should reduce one or both of the firm's products. So when we're trying to decide whether or not we want to change our product mix, we want to look at our sales quantity, the market share, our market size variances, and any possible changes that might be happening in the market. So based on their evaluation, they decided to plan for a possible reduction in that FB33 product that they had originally thought was going to have a higher percentage of sales. And then we know that in step 5, we provide ongoing evaluation of the effectiveness in what we decide. And then if we decide to redo, we go back to start the steps all over again. When we look at results from one year to another in our sales mix analysis, we're going to look at performance analysis to see if we had varying performance and what effect that had on our results. So we're going to look at the prior period results and see how that affects our information. So we have the Schmidt example that we're still looking at. So in January, we had a sales mix of 30%, 70%. And in December, our sales mix was 32% to 68%. How have our prices changed? Well, now we have that the one product has increased by $5 and the other product has decreased by $10. Because of this decrease, that has an impact on our contribution margin, especially considering that the product that had the sales price decrease was 70% of our sales mix. So it couldn't be offset by the fact that the other product had a $5 increase. We still had reduced operating income because of the combination of our sales mix and the price changes for these two products. When we expand that out further, we see the sales price variance versus the sales volume variance and our flexible budget information. So we see that a lot of the contribution margin variance is caused by the fact that that FB33 product dropped in price by $10 a unit. So that contribution margin also changed. So then we can see the sales mix and sales quantity variances by looking at our sales mix, our change in mix in units sold from January to December. So in January we had 0.3 and in December it was 32%. And then our change in the quantity of our results. So in looking at chapter 16, what we're looking at are productivity measures. And productivity measures are looking at what we're doing with our resources. So anytime we improve productivity, we're doing more with fewer resources. That saves us money. We're also looking at evaluation of sales performance. So we're looking at selling prices, sales volume, sales mix, our market size, and our market share information, and what the variance is between those different things. And that is the end of chapter